Hey, well, I'd like to welcome back a longtime friend of the show. He's a real estate and macroeconomics pro. He's an expert on raising capital, where he's authored an influential book. He's a frequent speaker at prestigious real estate events. He is the host of the Real Estate Espresso podcast. A Canadian, he also runs the Ottawa Real Estate Investors Organization, yet he's got time to be here, although he largely does invest in the U.S. Welcome back to GRE, Victor Menasce.
Great to be here, Keith.
Hey, it's so good to have you. It's been a few years. So much has happened. So much has changed. I know oftentimes you discuss global instability. As we talk in today's conversation from bigger picture to smaller picture, what are your thoughts with regard to global instability?
Well, first and foremost, real estate is always hyperlocal. It really starts at the hyperlocal. And it's so important to make sure that you are focused on that first and foremost. And at the same time, so much of what's happening in the world of real estate investing is, in fact, being dominated by the macroeconomic environment. The cost of capital has gone up so much with the increase in interest rates. And if you're locked in for 30 years and you're good to go, well, then this is completely of no interest to you whatsoever. But if you are looking to do new projects, if you have projects that you have been contemplating, or if you have projects that you financed initially with bridge debt, which a lot of people do, hoping to refinance into permanent financing, this is a major, major concern. So the macro environment is absolutely dominating the hyperlocal today.
This hike in interest rates is due to inflation. I know you've characterized today's phenomenon is what you call secular inflation, this long-term inflationary trend. And this really causes pain for some people. And interestingly, with you being a Canadian, you can relate to this in your local market, perhaps there at the Ottawa Real Estate Investors Association, since typical Canadian loans reset to market rates every 5 years. Therefore, could a borrower's mortgage payments, which is often the biggest payment in their life, double or triple overnight there in Canada?
It absolutely can. And there's a lot of even commercial loans, even in the U.S., that are written on a 5, 7, or 10-year term, and you can experience the same thing in the U.S. If you happen to get agency financing, Fannie or Freddie or something like that, where it's a fully amortized loan, then that's some of the best financing out there, and you definitely want to get that and get it rate locked as early as possible for as long as possible. And yeah, it's a major issue, making sure that you have enough financial runway. And we saw it even in the wake of the great financial crisis post-2008, that there were a lot of borrowers, even in the U.S., who made every single loan payment on time, and then that note came up for renewal at the end of a 5 or 7 or 10-year term, and they were upside down. And the bank said, well, you can keep the loan, but you're going to have to write us a check for 50, 100, 150 grand just to keep the loan in good standing. And some people didn't have them. Those were called maturity defaults, where the loan matured and they simply didn't have the cash to bring to the table to fix an upside down situation.
Truly a concerning time. Here for a long time, we have just recommended the plain vanilla loan, the 30-year fixed rate mortgage. And those that have done that have certainly been the beneficiary. And oftentimes the world looks at American borrowers with envy. In a sense, we are the ones that get to decide if and when we want to reset our rate. So if mortgage rates climb up, we're already locked in. And if they go down, we can go ahead and alter the deal, if you will.
Absolutely. And yeah, that's a great thing. Now, of course, a lot of these longer loans come with yield maintenance, which means a prepayment penalty. In a lot of cases, you might have prepayment terms that might be on a 10-year calendar. So 10% prepayment penalty in year 1, 9% in year 2, 8% in year 3, and so on. So you want to be careful about prepaying a loan. But in a lot of cases, especially if it's commercial, some of these 30-year loans and 35-year loans, if you're working with HUD, those can be assumable loans, meaning you can sell them with the property. Now, of course, in the world of residential underwriting, you don't have that flexibility. It's absolutely due on sale. But with commercial loans, you often have the ability to have an assumable loan as well.
Sure. In the multifamily and commercial space, those prepayment penalties are certainly more common, even here in United States real estate investing. Can you speak more to the global instability and the ripple effect that that's having throughout the economy beyond just interest rate hikes?
I'm seeing signs in the marketplace that are looking very 2008-ish in terms of the way banks are behaving with each other. And even prior to the great financial crisis, the signs were there in 2007. If you look at the banks that were accessing the discount window at the Federal Reserve looking for liquidity. Now, back in those days, they were doing it often through the hands of a dealer, often Citibank or someone like that, so that if you were a weaker bank like a Washington Mutual or a Wachovia or someone like that, you weren't putting in necessarily a big flashing red light bulb on your forehead saying I'm in distress. So oftentimes, a larger, more established bank was taking the hit for that. But today, accessing a liquidity facility like that has a stigma associated with it. And so banks are very reluctant to do that. If you want to see those types of transactions happening, they're happening in a much more clandestine manner through the Swiss National Bank, where the Swiss National Bank was conducting what are called currency swaps with the Federal Reserve. So these are typically Swiss subsidiaries of foreign banks that are looking to get U.S. dollars, and they're doing it through the back door, through the Swiss National Bank, to essentially obscure who the real troubled party is, so that you can kind of hide that, keep that out of the public eye. And there's a lot of that sort of activity going on, an increasing amount of activity. And it's something we need to pay attention to, because those signs of instability, the lack of liquidity in the market, and when we say lack of liquidity, what that really means is the quality of the collateral that is being pledged for this liquidity is often being put into question. And so it would make sense, for example, that, say, Italian sovereign debt would be priced differently, would come at a premium compared with, say, Germany, or that, you would pay more for Argentinian debt than you would pay for the UK, and so on. So, you've got to pay attention to what's happening. There's really three escape valves that anyone in financial distress has. Number one, they sell an asset. Number two, if it's a sovereign situation, then it's captured in the exchange rate. We've seen that recently with the United Kingdom. And number three, you see it often in rising bond yield, which means the value of that debt is falling in order to increase the yield. That's the market telling you that they want to attach a risk premium to that piece of paper by giving that piece of paper a haircut, give it a value reduction in order to increase the yield. So those are the three typical escape valves that we see.
Lenders applying a risk premium, basically charging a higher cost of money reflected in an interest rate to compensate for lesser quality collateral. We're seeing that all over the place. So, Victor, when this hits us on the street level or on the homeowner level or on the borrower for an income property level, do you see where potentially we could see banks doing things like freezing home equity lines of credit? Because you talk about the problems in the liquidity market. How can that trickle down?
Absolutely. We could see lines of credit get pulled in. For example, you might have let's say a $200,000 line of credit against a property, and you get a letter in the mail saying, congratulations, that your line of credit's now been reduced to 50 million or 50,000 or some smaller number. And then really you have no recourse at that point, because the mortgage is still in place. The mortgage is typically recorded at more than the value of the property. So even if the loan amount was for $200,000, they would have probably recorded a mortgage for in excess of the value of the property to prevent you from putting a second lien on the property. And you have very little recourse at that point. So it's something we definitely need to pay attention to. Maintaining dry powder, maintaining liquidity, maintaining cash is not something you want to do a ton of in an inflationary environment, because you're definitely losing value. And at the same time, you got to have some cash for those types of surprises when they occur. And I suspect that we're going to see some of that over the next 12 to 18 months.